Alright, ladies and gentlemen, so finally हम start करने जा रहे हैं हमारे next technical sessions. So first of all, yes, ladies and gentlemen, I would like to invite on stage our session chairman, CMA Arindam Goswami sir, our CM WIRC sir. Please kindly join us on stage. Ladies and gentlemen, जोरदार तालियां हो जाएंगी everybody. The technical session roll up cost accountings in direct and indirect tax planning. So, first of all, our chapter representative CMA CA Ajay Pandey sir, आप रिसीव करेंगे हमारे स्पीकर CMA अमित सरकार सर का.
We can give brief profile of our speaker. Amit Sarkar is a partner in the indirect tax practice of Deloitte India, handling indirect case taxation, and is based in Mumbai. He has close to 25 years of post-qualification experience and handles clients across multiple industry sectors including industrial manufacturing, logistics, pharmaceuticals and financial services. Amit Sarkar is a proficient in handling all Indian indirect taxes. He has also significant experience in handling custom, SECL and foreign trade policy matters for prominent clients. Before joining Deloitte, he has also worked with PwC as an indirect tax specialist. Prior to his consulting stint, Amit has worked with leading companies across manufacturing, project engineering and retail sectors for close to 10 years. His work profile including handling indirect tax, commercial and accounting in various capacities. There is a perception that cost accountants have limited role in tax planning. Our new revenue comes in DT in the form of physical verification, inventory valuation under section 142(2)(a). Indirect taxation is a transaction tax and hence every new transaction may receive to be evaluated to understand and optimize tax incident. Designing tax compliance processes, minimizing tax leakage are also important areas for professional accountants. Now, I hand over mic to our speaker, Amit Sarkar sir.
A very good afternoon to all of you. Dignitaries is on the dais, off the dais, CCM, RCM of the Institute, distinguished guests of SECL and the Bilaspur chapter of Cost Accountants, and young CMAs and CMA students. It's like a homecoming sort for me because I owe my childhood to Coal India because my father used to be working with Coal India. And luck didn't bring me here in my childhood, but I come here now after 25-26 years of qualification. Now my topic today is about taxation. I am a specialist in indirect tax, and not only indirect tax, I think I will try to break a myth of indirect tax today, that indirect tax as a practitioner, as a professional, is not GST only. There are other areas also which I will try to explain to you, especially for my young CMA friends, young CMA students. I strongly believe, after working for so long, that any professional, be a cost accountant, chartered accountant, company secretary, or any professional, I think our thought processes need to be expanded to succeed in life. If we do not expand our thoughts, if we do not spread our perspective, it is difficult to move ahead in life. In Navi Mumbai chapter, where I belong to, and Devashish Mehta ji is here, we have a tagline called Think Beyond Horizon. And that is the tagline that we have been using for years now, since the beginning of the chapter. And the idea and objective of that was that we as cost accountants should not limit ourselves only to traditional accounting and cost accounting. It should be beyond that, much beyond that. So here I am before you, and I'm blessed to be here. Being a cost accountant and being a partner in one of the big four firms, which is in my days I couldn't think of, but God was kind to me, and I did what I had to do. I did what I wanted to do, and I'm here before you. So, as I said, trying to break the myth that cost accountants or accountants, can they go beyond traditional accounting and traditional taxation also, is something which I want to talk to you. Mr. Datta, when he gave me the mandate for this session, he told me that I want you to focus on how can planning, how can optimization be part of our thought process as tax professionals. So let me start with some areas in indirect taxation. Now, as I said earlier, indirect tax, according to me, is not indirect tax only, it is much beyond that. And I'll try to give you some examples why I say that. See, if you look at indirect tax, it is a pass-through. What I mean by pass-through? It means that someone has to bear the incidence of indirect tax. And ultimate consumer will bear the incidence of indirect tax. Therefore, it's a pass-through. For the business, it is never or should not be the cost. That's the fundamental principle, right? Now, unfortunately, there are some indirect taxes which are part of cost today, and I'll talk to them in a bit. But normally speaking, any indirect taxes should not be part of your cost. That is the principle, and that is how global VAT systems are also designed. If you look at European VAT, if you look at UK VAT, all of them are designed in that fashion. Now, coming to Indian context, if I start a business, what do I need to do? I need to know what am I going to do in terms of offering products and services to my customers. What is my product and what is my service? And there, whether that product or service, what kind of taxes attract that product and service is the first question. Today, as you would know, that not all goods are covered in GST. Petroleum products are out of GST, alcoholic beverages are out of GST, right? But all other goods are in the coverage of GST. Within those also, some goods are exempted from GST, like rice and food, some of the food products are exempted from GST. So first and foremost, what I would like to emphasize to all of you, and especially again, I'm repeating for the young members and the young professionals, where you start your planning is to know your product and know your service. What is the tax that you need to apply? What is the effective rate of that item? Unfortunately, our taxation system remains, I would say, not as simple as it ought to be. So if I have to determine the rate of a particular item, I have to go to at least 2 different notifications, not one, right? So if I have to do that, then I need to know those notifications also. Where is that tax rate coming from? Therefore, the importance of classification, that means where is my product falling or my service falling, and what is the effective rate of that item. An effective rate, I mean, I'll give an example. One item can be sold, the tax rate is say 18%. But if I supply to a research institute, it attracts 5%. And that is conditioned on that the research institute has to issue me a certificate for that particular kind of concession. So the same product, if I sell to a non-research institute, it will attract say 18% or 12%. But if I sell to a research institute, it will attract 5% on the basis of a certificate from the institute. So even in law, there are exceptions created which we need to be mindful of. So therefore I said, know your product, know your services well, so that you are able to plan what is or know what is the output tax that you are supposed to collect from here. As I said in the beginning, indirect tax is a pass-through. It is not your cost. It has to be collected from your customers. So you need to know what is the tax rate I have to collect from my customers. That's point one. Point two, by doing various kind of transactions, can I get some incentives or benefits? How does incentives or benefit help me? It may not be directly indirect tax. It may be something else. Let me give an example to you. Most of the state governments today have an industrial policy. Almost all states. Each of the industrial policies of the states have an incentive scheme. What is that incentive scheme? It says that if you set up a greenfield project in that state, you will get incentives in the form of reimbursement of GST, reimbursement of state GST. Right? Now, if you get reimbursement of GST, it means whatever GST in cash you are paying to the government, you will get it back. Right? Now, that is an addition to your P&L. That's an added income to your P&L. But do you know whether you are eligible for that, first and foremost? Second, does the state government where you plan to set up a greenfield project allow that kind of a benefit? So the point is, do I know the economic, industrial policy of that environment where I am supposed to work? Right? So if I am going to work in, say, Telangana, I am going to work in Madhya Pradesh. Now Madhya Pradesh and Chhattisgarh, there are a lot of schemes which are being offered now, especially Madhya Pradesh. If you look at their industrial policy, there are a lot of schemes which have been given to greenfield industrial projects. And most of them would have an element of GST benefit coming to the industrialists. So first, as I said, do we know the central and the state incentives? Let me give an example of central incentive. The government of India is now trying to make Atmanirbhar Bharat. What does it mean? It means that government wants manufacturing capability in India of specific sector, specific goods. And therefore, they have given incentive schemes for those particular products. For example, pharma sector had an incentive scheme, in fact 2 incentive schemes. Solar PV cells had incentive schemes. Food processing sector had incentive scheme. So in all, till today, there have been 14 PLI schemes, production-linked incentive schemes given by the government. Now all those schemes have an impact on your P&L. And how? Because if you get those incentives from the government, it increases your income or your other income. Now, does that other income attract a GST? Is something that we should know as a tax professional, because it's an incentive. Is it a subsidy? It is not a subsidy, it's an incentive. Would that impact your P&L? Yes. If the answer is yes, would that be accepted to GST? That we should know. Right? So I am just trying to connect the dots between the allied subjects of incentive schemes and others to the topic of indirect taxes, and trying to help you to understand how these schemes impact the business. Let me take one more example. Foreign trade policy. Any one of you would have heard about the foreign trade policy, where we have various schemes. We have schemes for importing goods. We have schemes for exporting goods also, right? When we export goods, we get a scrip or incentive called, today it is called RoDTEP, R-O-D-T-E-P, RoDTEP scheme. On RoDTEP scheme, it is directly a percentage on the export value of goods. Whatever you export, you get a direct percentage on those goods. Again, that's an additional income that comes to the company. But when I'm planning and I'm drawing up a forecast plan for my product or a service, do I know whether my product is eligible for that scheme? Is the question. If it is yes, then I draw my P&L accordingly. Right? Similarly, when I talk about free trade benefits, today world is connected. Gone are the days where we used to wait for days to connect with the world. When we are talking about connecting to the world, India has got a lot of agreements with multiple countries. Singapore, Vietnam, Malaysia, these are called free trade agreements. Very recently we have signed agreements with Australia and UAE, Dubai, Abu Dhabi and all that, all those states. How does it impact us? If I am exporting goods to those countries, the free trade agreements say that the governments of those countries will give customs duty exemptions or customs duty concessions. Which means what? The incidence of customs duty on my product in those countries will be low as compared to an export from some other country. So therefore, that particular country's importer will have a lower cost of import as compared to some other country. So are we able to factor that? Therefore, the importance is we understand which free trade agreements are applicable in India. Are my products covered in the free trade agreement? Which countries I am supposed to export goods to? Or will those countries, do those countries have a free trade agreement? Is the question. Now, very specifically for cost accountants again, there is a regulation called Make in India regulation, which was first announced in 2017 and then it was upgraded in 2020. What does that say? It's a DIPP order, Department of Industrial and Public Policy order, which says that any goods which have to be supplied to the government through the e-portal, for the supplier to become or qualify as a local supplier, the supplier has to ensure 50% of value addition happening in India, which means 50% of the value addition or the conversion cost has to happen in India. So if someone is only importing and packaging goods and supplying, that will not qualify as Make in India. And if it doesn't qualify as Make in India, that particular supplier will not qualify as a preferred or a local supplier to the government. That means he would lose out. Now how does cost accountants play over here? There is a publication of the institute itself, which we have published, how to determine this value addition. How do you compute this value addition? Now, as practitioner, we are doing engagements there with multinational clients, where we are helping them to derive how to compute that value addition, what kind of records they should maintain, what are the elements of cost they should consider for that value addition. Now, if I do not know the Make in India proposition, if I do not know the DIPP order, if I do not know, in addition to DIPP order, again interestingly, there are 5 different ministries like the Ministry of Chemicals, the Ministry of Electronics. They have issued their own guidelines to compute value addition. So I need to know which product I am selling, what is the guideline applicable to my product, and accordingly I need to compute the value addition so that I know whether I'll become a preferred supplier or not. But how does it get linked to your indirect tax again? In your cost, are you taking all the eligible setups so that you are able to compute your cost accordingly? Are you taking all the input tax credit that you were supposed to take and therefore you are computing your cost accurately is the question. Right? So it is not Make in India directly impacting your calculation. The Make in India is also impacting your calculation because you need to know your cost accurately, and the cost comes from the GST rules of the corresponding acts and rules. I also mentioned about global practices for cross-border trade. Now let me add one more angle over here. When we export goods to US, when you export goods to UK, when you export goods to the EU, Belgium, Netherlands, Germany, etc., etc., in those countries, there is a concept of preferred importers or preferred suppliers. What is that meaning? The meaning is that when I'm exporting goods from India to those countries, my goods will be given preference for customs clearances. Right? When the customs clearance is happening in those countries, they will give special preference to my goods because those countries might have signed an agreement with India or there is a program called the Authorized Economic Operator Program, AEO in short, again run by the CBIC, the Central Board of Indirect Tax and Customs, which recognizes the practice between the two countries. So, all these is a combination of not tax only, it is also a combination of the regulations and the allied policies of industrial promotion, export promotion or cross-border trade. We need to be mindful of all these for designing a forecast, P&L and our business plan. Now coming to a specific area, again from GST. When we are talking about valuation of goods, the topic of valuation of goods, it is defined in the CGST Act and the CGST rules, and there are various situations in the CGST Act and rules. So very simply put, if I am transferring or stop transferring goods from one location to another location, I can take any value according to the CGST rules, Rule 28 of the rule. It says that if the opposite party is able to take full credit, that means the recipient, I can value the goods, or the invoice value will be taken as the transaction value. Is that the right approach? So can I assign a value of 100 or 0 or 10 to a particular item? The answer is no. You have to still apply the principles of valuation to arrive at the reasonable value for the item. So these are the aspects that one needs to consider when we are considering the outward supply portions. Outward supply means what am I selling? Am I selling goods? Am I selling service? And what are these environment that I need to be mindful of? Now let me turn my attention to the inward supplies. When I purchase, see, if you are purchasing, there can, according to me, there can be two broad categories, either capital or revenue. See, if I am buying capital goods, if I am buying goods for a capital project, there can be a host of benefits. If I am doing an expansion, if I am doing a brownfield or greenfield expansion, if I am doing a ramp up of my manufacturing or production facility, there can be a lot of capital expenditure, and each of those capital expenditure can have multiple impact. And I can have cost savings opportunities, because capital goods will reduce the cost. If you are saving some taxes there, your cost of setting up their operations will go down, right? Your capital expenditure will go down. Now let's look at how do I divide this. There can be two kinds of supplies. The source can be two. Either it can be indigenous or it can be imports. If it is indigenous, I will come to that later. But let us look at imports first. There is a scheme called Project Import Scheme of the Government of India. If I am importing goods for expansion of a plant, even that can be covered under Project Import Scheme. What is the benefit of Project Import Scheme? Any item which I import, and if that project is registered under the Project Import Scheme, will attract a 7.5% basic customs duty. Nothing more than that. It was 5% till last year. It was increased to 7.5% from the last year. But imagine if you have to pay 12.5% on certain goods, 15% on certain goods, as compared to that you are paying 7.5%, and you are saved from classifying the goods in their as many categories, you can straight away benefit from classification as well as cost savings in respect of those imports. In the foreign trade policy again, there are schemes which help you to save the customs duties. If you are going to import for exporting of manufactured goods, you have a scheme called the PCG scheme, the Export Promotion Capital Goods Scheme. If you are importing raw materials, you again have schemes like Advance Authorization and DFIA, which help you to save customs duties on the imported raw materials as well. But at the same time, even the customs law gives us a lot of exemptions. It is not only the foreign trade policy, even the customs law gives us a lot of exemptions, and it is not easy, mind me, it is not easy to track those notifications. In spite of working for so long, we also struggle to find those notifications because they are not very easily coordinated. So if you have to find an exemption or effective date of an item, you have to browse through at least 3 or 4 notifications. Then you can reach a conclusion. So the point is, am I knowing those notifications and how does it flow to arrive at an effective rate which will benefit me, help me save my cost. On import of services, there is always a dichotomy whether it will be the value of import should be subject to customs or should be subject to GST. And I'll give an example. If I import a software for a machine, right, a software which is used for activating that machine, and I pay the value of the software separately to the supplier, and he sends the software only through a digital means. He is not sending the software on a CD, he is not sending the software on a pen drive, he is sending the software to me digitally. Right? So it will not attract customs duty or it will not pass through the customs court. So if I have to pay, if now I have to pay a value for that software, should I subject that to customs because the machine will not work without that software? Or should I subject that value of software to GST only because it's an import of service? So there are disputes on this, there are decisions also on this, but the simple point is, if this software is essential for activating or using that equipment, we cannot segregate that software from that equipment. Although we are importing it or we are getting it separately delivered. And therefore, courts have held that in those situations you have to add the value of that software to the value of the machine for payment of customs duty. Now, if the software comes later and the goods comes first, then what do you do? How do you pay the additional customs duty is the question. Therefore, we should know what goods I am importing, what services I am importing, what is the nature of the services, and do I have an implication of customs and GST on that expenditure. Right? Now again, if you pay import GST, which is reverse charge, it's a pass-through again. You pay at one hand, you take the credit on the other hand. It's a pass-through. There is no cost impact, it's only a cash impact. You take in one pocket, put it in the other pocket. That's it. But if it is part of customs duty, the basic customs duty also goes up. And therefore your cost also goes up. Right? So the nuances lie in the fact that I need to know again what is the impact of classification and valuation for my imported goods and services. Now let me turn to domestic supplies. Domestic supplies, I mean, we are talking about capital expenditure over here. When we are talking about capital expenditure, you know that civil construction expenses, we cannot take a single rupee credit. Right? It's completely outside the purview of input tax credit. It's part of blocked credit as we know, as we call it. But if we are having an expansion plan where there are good amount of plant and machinery, civil expenses, in those civil expenses there can be some which are part of a works contract. In those days we used to call it works contract, today works contract is not there, but we call it composite supply. So let me take an example. Suppose in this hall has to be renovated, and there is a turnkey contract for renovating this hall, and the contract says that there will be civil work, there will be electrical equipment, there will be air conditioners, and there will be other chairs, furnitures, etc., which is a turnkey contract altogether. Now, if this is one contract and there is one value, and everything is billed by the contractor as a composite supply, and I also account it as a plant and machinery or a civil, a land and building expenditure in my books, I am foregoing the opportunity of taking the credit on those expenses or those items where I could have taken a credit. For example, if you place a separate order for the furniture and just pull it out from the contract, furniture is eligible for input tax credit. You can take the credit on furnitures. The air conditioners put over here, you can take the credit on the air conditioners. That is not outside the purview of input tax credit. So it is important for us to understand that if I get a composite supply, the contractor may not know. It is for me to know whether the contractor is able to supply the goods or services in a manner which is giving me the most cost-effective option. Let me move to the next point. On the revenue side again, the revenue expenditures will be ongoing expenditures where you need to identify what is the principal supply and incidental supply. What I mean to say is, if it is a goods and a service or a service and a goods, what is the principal supply and what is the rate applicable on that item? So that dichotomy, that contradiction still remains in GST. Do I have the ability to take credit on all large supplies? If the answer is yes, I can take credit, then it is a pass-through again, it doesn't impact my cost. Reverse charge supplies. Now, one of the important things that I must mention to all of you regarding reverse charges, the authorities are looking at reverse charge accounting very, very carefully. If you have multiple registrations of GST for a particular company and you want to pay all transportation expenses, GT expenses from the corporate, although you are availing the services across other states, that will, and you pay the reverse charge at the corporate office, that will not be allowed. Department is saying wherever you are receiving the services, account it there, pay the GST there. And why? Because the reverse charge GST is a cash accrual to the state governments directly. It goes to that particular state where the services are consumed. If it is consumed in the corporate office, then it goes to the state where the corporate office is located. So accounting of reverse charge is very important. Wherever you are recording those expenses, those are the places where you should be consuming those services also. Otherwise, it will be a difficult proposition to justify that I am paying all reverse charge from one central location. Inverted duty structure. Now, coal industry is obviously under inverted duty structure, and I don't need to again delve on that. But when I am starting my business, when I am doing a new project planning, do I know whether I am under inverted duty structure and what can I do to either eliminate inverted duty structure or minimize the incidence or reduce the incentives? So if I anticipate that whatever credits I will get, I will account, and that is a pass-through in my books which does not impact my cost, whereas that credit is never going to be fully utilized because I have an inverted duty structure, which is the case in coal industry as I understand, then that asset is futile. That asset is of no use because you will just hold on that asset in the books. So to the extent the input tax credit cannot be utilized and just remains in your books as an asset, it is an ineffective asset, and ultimately it might come back hitting your P&L at a point in time. In GST, we do not have a concept of writing off unutilized credits, and therefore you can continue to hold on to that asset for long. But what will you do by holding to that asset is the question. So when I am doing a project planning, I need to know whether I am subject to inverted duty structure and how much of my credit I can actually take in my asset and how much I may not take in my asset. I may have to do a pass-through, expense out of the GST. I touched upon the inward supply point, which I mean to say that if you are receiving goods over here, services at one particular location, we have to ensure that the services are actually being consumed in that location. Otherwise, just doing a planning will not work. Last point on this is about input service distributor. If you are looking about input service distributor concept, it was there even in excise. Very simply put, input service distributor means you are paying for a service expense and you will distribute the GST to your other locations. That's the simple concept of input service distributor. But tax authorities are challenging on this big time. In most of the GST audits today, if corporate office has taken the entire credit and then they have passed on to those credits to the other offices by issuing an invoice, not an input service distributor invoice, those credits are being denied. So there is a decision of advanced loading of companies which is being put to use, and that decision says that if the corporate office is paying for an expense but not receiving those services, then the corporate office cannot take the credit of those expenses. Right? And those expenses will have to be routed through the input service distributor route. The corporate office has to take the ISD registration and distribute it through the ISD route. Otherwise, it will not be applicable. So this is something I would like to again invite your attention. Please study about ISD. Please study the advanced rulings about ISD and look at the implications in whichever department, whichever field you are working, because that's going to be a controversy in the coming days very soon. Now, what we talked about in the previous two slides, it is not only about planning in advance. On an ongoing basis also, we need to be mindful of our compliance process. This can also lead to tax leakages if you do not control your processes diligently. I'll give an example again to illustrate. Today we can take credits of GST only when my vendor has a valid GST registration. If my vendor's GST registration is suspended, I cannot take the credit. How do I know whether my vendor's master GST registration is valid or not? You can do that. You can also update your masters accordingly. Are you taking credits on valid GST invoices is the question. Now how do you do that? Again, you need to have a basis, and here all these that I am talking about cannot be done manually. Everything has a digital solution today. Everything can be done digitally, right from checking master data to doing reconciliations using bots, anything to do with periodic dashboards and having dashboards before the management people. Everything can be done digitally and has to be done digitally. You need to have sophisticated, and I'm not talking about only SAP or Oracle, there can be homegrown softwares also which can be used for tracking all these compliances. The important point over here is, am I able to minimize the tax loss or tax cost or input tax leakage by having a diligent control system is the point. And this control can only come when you, in a big company or in a mid-sized company also, you have adequate controls which are supported digitally. Let me give an example. Tax authorities are asking how many vendors you had as of 31st of March whom you did not pay within 180 days, but you have taken the GST credit. So if you have outstanding liability of X crores, trade payables of X crores, they're asking for a backup of those invoices and what is the outstanding status of those invoices as of 31st of March. If we are not able to provide the details, they are seeking to disallow that credit suo motu. What does it mean? That I need to have a backup of all the trade payables or creditors which I have as on 31st of March, and also depict that those invoices have not crossed 180 days. But can it be done manually? Impossible. Therefore, you need to have a backup of all these invoices and preserve a report as of 31st of March, and you can provide before the auditors when they come to audit. Next example, write-offs and retirement. As per accounting standards, as per company policy, we may be doing write-offs of fixed assets or sale entries. Tax authorities are trained today to read the financial statements way better than professional accountants also, because only members of CA Institute and Cost Institute have gone and taught them. So they know where to read to find out write-offs and retirement. And they are saying, if you have done a write-off, have you reversed the input tax credit? If you have done a retirement, have you done input tax credit reversal also? Therefore, I need to be prepared and at the back of the mind that I should not be up for a surprise 3 years down the line when the audits are happening for GST. So, and now, how does a tax person know that certain assets are being written off? Tax person would not know, right? Only the fixed asset guy would know how much asset has been written off. But what is the system you have put to integrate the two, that the tax person also comes to know that the fixed asset is being written off, and therefore the tax person also knows what is the amount to be reversed for input tax credit, or the fixed asset person should also know that there is a reversal impact on retirement or writing off of fixed assets. So question again, I'm trying to impress upon you, there are interlinkages which are easily traceable today, and we need to be mindful of this, and we need to be using digital techniques, electronic techniques to tackle those situations. Last but not least, recoveries and reimbursement. Lot of transactions happen as reimbursements. We may say I have reimbursed this amount, we may say I have recovered this amount from my employee, or we may say I have given reimbursement to so and so. It is important to analyze or evaluate whether those recoveries have a tax impact. Because even the service tax regime, a lot of cases have happened on reimbursements, and Supreme Court had to opine on a particular ruling. Having said that, in a large company where you may have small reimbursements at various pockets, it is important that we have a SOP around those reimbursements and the documentation of the SOP, and whether that has an impact of GST or otherwise, that needs to be clarified to the person who is releasing those reimbursements or recharges. So, more and more, it is with GST becoming completely digital, the filings becoming completely digital, the tax authorities are also able to track a lot of information and data on their own, and we need to be mindful of capturing all these control points and have a specific SOP for each of these. And whatever is written on this slide is not something which is academic. I have put this basis my experience of dealing with a variety of clients. Let me take a pause over here. If anyone has a question before I move to income tax, although I am not an income tax subject matter expert, but I'll still try to give you some perspectives on income tax. But before I go to this slide, anyone has any question?
One point, if you just kindly highlight, if it is possible, if you just kindly touch upon any issues on the labor cess, particularly. Labor cess. If you just kindly touch upon, because so many points I have noticed that in the WIRC contract, particularly in the projects, particularly in the revenue projects, there are a lot of issues are coming on the labor cess. If you just kindly touch upon.
So labor cess, as you know, is not it's a state subject.
That's right.
Right? And even the statutory provisions are different from state to state. Now, in some states, there is no concept of labor cess. In some states, there is still labor cess still prevails. Now, in most of the states, as I have understood, labor cess is independent like a professional tax in Maharashtra. Right? Although the professional tax is managed by the state GST authorities, like the VAT authorities in Maharashtra. So although the administrative authority is same, the legislation is different. So we have to go back to the Labor Cess Act of that particular state and deal with the compliances. But if you are talking about the planning part, yes, if we are dealing with projects, it is very important to know about the labor cess. In addition to that, I will also add one point about professional tax. Because if you are running projects, then professional tax also has an impact on the compliances of those projects. Even if you don't have a fixed office, or if you have offices, if you have a minuscule office with limited number of employees, that can also have a professional tax implication. Right? So it is difficult to give a very pinpoint answer on labor cess, but every state has a different legislation, so to say. And unfortunately, this legislation is not easily available as well. That's the fallacy. Like the state excise acts. State excise acts are applicable for alcoholic beverages. Right? You can't find a very standard book on state excise duty. If I come to Chhattisgarh and Madhya Pradesh, I will not be able to find out a very good book on state excise duty. That's the problem.
Fundamental problem comes when the question of labor cess is coming. We, the layman, understand that the labor cess is mainly for the building workers.
No.
But the act is governing like this. If you read the nomenclature of the act, it is applicable for the level
wherever you have workmen, in other words, it's workmen. But definition of workmen will vary from state to state. That's the problem. So coming to income tax. Now for every tax professional or accountant, we go through the provisions of income tax as part of our curriculum. It is a different story that when we qualify, we practice either accounting, cost accounting, MIS or indirect taxation, but very few of us may be handling direct tax on our own or independently. But according to me, today's Income Tax Act is moving towards simplification because of two reasons. One, the tax rate, if you look at, today we have a corporate tax rate of 25% plus surcharge, which is about 25.17%. When it is 25%, if a company opts for that particular rate, they will not be able to take a host of deductions, right? Which means in other words, the government is saying you get a lower rate, but you cannot claim most of the exemptions that you were claiming earlier. Like our new personal tax regime. In the personal tax regime, we don't pay tax today if my income is up to 7 lakhs. But I will not get a ETC benefit there. I will not get a ETD benefit there. I will only get a standard deduction. Similarly, in the Income Tax Act, if I go for a 25% tax rate, there are a host of conditions which include that I should not, namely, I cannot go for accelerated depreciation, I cannot go for a special area benefit, I cannot go for Section 80IA benefit and stuff like that. So government's intention is very clear. If you are opting for a lower rate, you have to sacrifice your deductions. Point one. Point two, the government is also making us accountable for compliances of our stakeholders like vendors and suppliers and customers. And that's for the reason. You would know that TDS was there on services, but now it has been expanded to goods. right? TDS is there on goods also. In addition, there is a TCS. So if I am selling goods, I will also deduct a TCS to a particular set of customers. So therefore, the government is allowing, and if I do not do these compliances correctly, I will still have a deduction, I will still have a problem in my income tax return. Which means either I will not have the deduction or that expenditure deduction, which means I will have a higher tax to pay. Right? If I am importing software from foreign, there is a new concept of equalization levy, which has come in 2016. What is equalization levy? Very simple example. If you advertise through Facebook, you get a lot of advertising on Facebook, right? All of us go for advertising on Facebook. Facebook will raise an invoice on you from a foreign country, not from India. That invoice has to come with an equalization levy. So if the invoice is for 1 lakh, it should come with a equalization levy of 6%, which is 1,06,000. Now, me as the recipient of advertising services of Facebook, I need to deduct 6,000 and pay to the government. And also file a statement called the equalization statement. If I don't do that, then I may be saddled with double the amount of 6,000 as a penalty. And that 1 lakh rupee which I have spent can also be disallowed as an expenditure in my income tax return. So if you are importing services which are digitally delivered, we need to be mindful about this new animal on the block called equalization levy. It is applicable for digital online and advertising services and online database services. One of the other things that government is looking at very closely is the TDS rate on withholding tax for foreign supplies. That directly has an impact on your tax deductions or expenditure deductions. If you do not deduct tax according to the provisions of law, or you apply a double taxation avoidance agreement wrongly, incorrectly, even then your expenditure can be sought to be denied. Right? So when we are, now there is a concept of what is fees for technical services, what is royalty, what is know-how, and all those complications of Income Tax Act. And therefore I need to be very, very clear when I am deducting TDS of foreign supplies. What is the rate? What is the nature of supply? Is it a fee for technical service? Is it a royalty? Is it a technical know-how? Is it an IP? And therefore, I need to accurately determine the rate of tax. In this year's budget, the government has brought a new provision on micro and small enterprises, right? Which says very simply that if you do not pay your vendors within the timelines given in the MSME Act, which is 45 days from the date of the invoice, then that expenditure will be disallowed in that particular year. It will be allowed in the year when you actually pay the expenditure, or actually make the payment. So, although it does not disallow or it does not make the expenditure completely disallowed, there's a timing factor. So, when I'm registering my vendors, I need to know which vendor is a micro or a small enterprise. I need to have a tracking mechanism that I am paying those vendors within the timeline of MSME Act. And if I do not do that, then at the end of the year I may have some potential deductions or disallowance for that particular year. It can only happen in the next year when I actually make the payment. So these are 31st March or accounting date considerations, and MSME Act will become very important, at least for the micro and small. They are not saying mid-sized companies will also come over here, but it is only about micro and small. Again, recoveries and reimbursements. Here also, the problem is, all recoveries and reimbursements are dealt in a certain manner, where people may not consider the income tax or the GST implications. So importantly, what we need to keep in mind is, are those recoveries, reimbursements leading to any kind of income, or it's a pure reimbursement and that is supported by documents? If it is supported by document, fine. If it is not, then we need to take a call. And lastly, this is a new area of practice for cost accountants, where the Income Tax Act has been amended this year, and they have inserted a section 142A in the Income Tax Act. A special audit can be conducted on the direction of an assessing officer for evaluation of inventory of a particular tax SEC, if the officer, if the AO is not satisfied with the value of the closing stock. Now, the power has been given to the AO. The AO will have an impaneled set of cost accountants with him, and those cost accountants can be asked to conduct a special audit of a particular SEC. Now, interestingly, there are two angles to it. The question is, which companies are covered over here? Are those only companies which are governed by cost accounting rules, or companies at 148, section 148, or is it any company? The answer to that is very simple. Any company, whether or not covered by section 148 or covered by cost accounting rules, are covered by this provision. Second point is, it also underlines the importance that whatever if I am not covered by section 148, and therefore I don't need to follow cost accounting record rules, or I am not subject to compulsory cost audit, even then I need to be mindful of the costing principles to be factored in valuing my closing stock. Because if that is not done, I may be subject to this special audit, and this will also help me to minimize differences, if any, in case of a special audit. So, this is an important, I believe, in my personal opinion, this is an important area where even the institute needs to work on in terms of bringing out certain guidelines about inventory valuation also, and the related intricacies with the income tax provisions. And most importantly, guide the practicing cost accountants also, do some training on that in terms of how to get into those areas.
Guidance is coming.
Very, very happy to know that. But I think it's more important to give exposure to the income tax provision, because that was not statutorily there earlier. And this is the first time I think the Income Tax Act has a specific certification or audit provision, right? So it is important that we need to show, or we need to demonstrate our capacity and capability here. So again, I come to, this was my last slide. I didn't want to make a long presentation over here. Thank you very much for inviting me and having me here and listening to me. If you still have any questions, we have 2-3 minutes to go. I am happy to take those questions. And I wish you all the best.
Chairman of the session, CMA Arindam. The Speaker of the session, CMA Amit Sarkar, and dignitaries of the dais. मित्रों, जैसा कि अभी तक ये सेशन समाप्त हुआ है और आपने देखा, the role of cost accountant in indirect and direct tax planning में CMA Amit Sarkar जी ने दिया। इन्होंने काफी ब्रॉडली इसको आपके सामने रखा, जबकि मैं समझता हूँ इसमें और भी इनके पास बहुत स्टफ रहा होगा, लेकिन समय की कमी के कारण थोड़ा शॉर्ट किया इन्होंने। तब भी काफ़ी चीज़ें इन्होंने कवर की। लास्टली इनकम टैक्स का जो सेक्शन 142(2)(a) जो अभी इंट्रोड्यूस हुआ, उसके बारे में भी इन्होंने डिटेल थोड़ा सा आपको बताया। और निश्चित तौर पर जितने भी यंग फर्स्ट अकाउंटेंट्स हैं और जो स्टूडेंट्स हैं, इनकी जो प्लानिंग, टैक्स प्लानिंग के बारे में इन्होंने बताया, उसको सुनने के बाद पूरी तरह से लाभान्वित होंगे, ऐसा मेरी आशा है। और ये सेशन आप सभी ने पेशेंटली सुना, सबके उसके लिए सबसे पहले आप सभी को धन्यवाद। मैं धन्यवाद करता हूँ सेशन के चेयरमैन CMA अरिंदम गोस्वामी जी को, और विशेष रूप से अपनी ओर से और आपके CMA बिलासपुर चैप्टर की ओर से मैं धन्यवाद देता हूँ CMA अमित सरकार जी को, जिन्होंने एक बहुत बढ़िया पेपर प्रेजेंट किया और आप सभी को टैक्स प्लानिंग के बारे में अवगत कराया। आप सभी का बहुत बहुत धन्यवाद।
उसके बाद मैं इनवाइट करना चाहूँगी लेडीज एंड जेंटलमैन हमारे चैप्टर रिप्रेजेंटेटिव CA अजय Pandey sir, GM Finance SECL sir. I would like to request present a moment to our speaker CMA Amit Sarkar sir. Ladies and gentlemen, please let's give a big round of applause everyone. Now I request, एक बार फिर से मैं रिक्वेस्ट करना चाहूँगी हमारे चैप्टर रिप्रेजेंटेटिव अजय पांडे सर से, प्लीज प्रेजेंट अ मोमेंट। Thank you so much everyone. Thank you so much all the honorable guests. Thank you everybody. So your tea is ready. I request everyone please enjoy tea.